Check out our market update on the indicators for inflation going forward. Hi, Jim Gore from THOR Wealth Management. It is important to have protection in your portfolio from inflation because there are many indicators showing us that inflation is here to stay. First and foremost, I had this chart at the end of our last market update. And this is looking at the federal government spending, right? If you notice that we kept pace up until 2005, if that continued, we'd only have a $12 trillion deficit. But we had a jump up there because of the Great Recession and another one after COVID, which is increasing our government spending. And as Milton Friedman said, inflation is always a monetary phenomenon. So the government is continuing to spend more money, printing more money, and we would have a deficit of only $12 trillion if we didn't increase our government spending. Instead, we're at $38 trillion, which is more than threefold where we should be if we followed the spending that we did in the past. Now, that is one side for inflation, but there's other indicators for inflation. First is copper. Copper is showing you that right now that the economy is growing. There's more demand for copper. And you can see that at the end of this chart, we've had a bump up in copper after being flat for 20 years. Before that, in 2002 to 2004, we saw a big jump up in increase, and that was the industrialization of China. Huge amounts of demand from copper from China for automobiles, for buildings, and so forth. Now, you might ask me, Jim, but wait a minute. We had some good growth back in the 80s and 90s in the U.S. Why didn't we see copper prices going up at that time? Actually, the reason for that was we had all those communist countries go under in the late 80s. And what they did is they dumped all their commodities on the market just to get anything in U.S. dollars. And that kept commodity prices artificially low. Right now, we're seeing that jump up in copper, and that's saying the AI expenditures that are happening right now is real growth in the economy, but it's also causing inflation from a commodity standpoint. Another thing is looking at the bond market. As I showed in the prior chart, we had 20 years where copper didn't really grow from 2004 up until just recently. In that time period, you made good money on longer term bonds, right? It was good to own bonds. We didn't have any inflation. But now that you're seeing, we saw a drop off. This is the TLT, 20-year ETF. We saw the price drop significantly, but notice in the last several years, you haven't made any money in bonds. You're collecting a 4.5% interest rate, but you're losing money on the value of the bonds. And why is that? Well, the bond market is saying to you that inflation is going to be around for some time. The only reason to buy longer term bonds is that you have faith that there's not going to be inflation and you will get your money back. When longer term bonds are not performing, there's a concern for the market for inflation. Another commodity, which is very important from a longer term perspective for inflation, is natural gas. And when you look at this chart, going back to 2012, through COVID, you actually saw natural gas prices were on their way down. Why is that? Well, we have fracking, right? So we have fracking, excess supply of natural gas coming to the market. But notice since then, we're going on an uptick here in natural gas. And natural gas is used for every industry, and especially AI. And that increase, now you see that blip back in 2022, 23. Well, we all know that was Russia invading Ukraine, but it's come back down. But more importantly is that trend for natural gas is going up. And that has to do with all these data centers now being built off natural gas pipelines for the energy sources. There's more demand for reliable energy, and that's coming from natural gas. So you have copper and natural gas are telling you that, hey, from a commodity perspective, we're for the first time in decades having commodity inflation, just like we did back in the late 70s. Now, the other one, especially for U.S. investors, that's very important, is the U.S. dollar. And this is looking at the U.S. dollar going back into 1970s, but I've highlighted a couple areas And you look from really 2002, 2010, the dollar fell in value. And you made a lot of money investing in overseas investments. But what happened was we had a long run here, about 13 years, that the US dollar was very, very strong versus other currencies. So that was a drag on inflation because we're buying a lot of goods from overseas and the dollar goes up in value. You can buy more goods with your dollars. That was a drag on inflation. However, what we've seen really in the last 18 months is a drop in the US dollar, the beginning of this. And we think that this is going to continue. So this is inflationary because our dollars don't go as far as they used to overseas, and we're buying goods from overseas. They're going to end up costing a little bit more. So you have it from the commodity side as well as from the Treasury side, and here again on the US dollars. So if you don't, here at Thor, we have 4 things in our clients' portfolios to help protect against inflation. I don't know which one is going to do well in the next year, but I think over the next 5 to 6 years, all 4 of those areas are going to perform well. The question is, do you have things in your portfolio to protect you from that inflation? If not, give us a call or reach out to us at thorwealthmanagement.com. Take care and talk to you in a couple weeks. Subscribe to the Thor channel today.